Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Mediaalpha Inc. Annual Report. Mediaalpha Inc. operates an insurance customer acquisition platform that offers end-to-end customer acquisition services to various clients across the United States. The company's technology platform caters to a range of verticals within the insurance industry. The list of businesses and services provided by Mediaalpha includes end customer acquisition for insurance carriers, end customer acquisition for distributors, customer acquisition in property and casualty insurance, customer acquisition in health insurance, customer acquisition in life insurance. These services enable clients to efficiently acquire new customers, expand their market reach, and drive business growth. Unfortunately, I am unable to provide an S, as I do not have access to the extracted summary. However, I can suggest some possible reasons why Mediaalpha Inc.'s stock price may have made no significant changes in the past year. The lack of significant change in Mediaalpha Inc.'s stock price over the past year could be attributed to a variety of factors. One possible reason is that the company has not released any groundbreaking or innovative products or services that would drive investor interest and boost its stock price. Another possibility is that the company's financial performance may have been stable but unremarkable, failing to generate significant growth or excitement among investors. This could be due to a variety of factors such as slow sales growth, high competition in the market, or operational inefficiencies. Additionally, external market conditions and economic trends may also play a role in Mediaalpha Inc.'s stock price stability. For instance, fluctuations in the overall stock market, changes in industry trends, or shifts in consumer behavior could all impact investor sentiment and influence the company's stock price. It is also possible that the lack of significant change in Mediaalpha Inc.'s stock price may be due to a lack of transparency or communication from the company. If investors are not provided with clear and timely information about the company's performance, strategy, and prospects, they may become disengaged and lose interest in the stock. In conclusion, there could be several reasons why Mediaalpha Inc.'s stock price has made no significant changes over the past year. Further research and analysis would be needed to determine the specific factors at play. Mediaalpha Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Mediaalpha Inc. trades at a lower price-to-book ratio of -17.15 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 118% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company are multifaceted. One key driver is the increase in open marketplace transactions, which accounted for 90.1% of total transaction value in 2025. This significant growth is attributed to various factors, including an increase in platform fees received from supply partners and a rise in consumer referrals sold to demand partners. Additionally, revenue growth is also driven by other sources such as click revenue, call revenue, and lead revenue on a pay-per-click basis. These revenue streams contribute significantly to the company's overall revenue growth. Furthermore, the company has seen an increase in platform fees received from supply partners, which has also contributed to its revenue growth. On the other hand, the primary drivers of revenue decline are more limited. The main contributors to revenue decline are decreases in health insurance revenue, life insurance revenue, and other revenue. Specifically, the decrease in health insurance revenue is attributed to scaling back under -65 health subvertical, implementing compliance measures, and lower demand from carriers and brokers due to MLR increases and enrollment program changes. The company's cost of revenue has also increased significantly, rising from $721,131,000 in 2024 to $946,057,000 in 2025. However, the sales and marketing expenses have decreased, indicating a potential shift in focus towards more efficient spending. Overall, understanding these drivers is crucial for identifying areas of improvement and making informed decisions about future growth strategies. The company's financial performance has shown a significant improvement in recent years. One key indicator of this growth is the generation of positive operating cash flow. According to the provided information, the company achieved this milestone in 2025, as stated on page 52 and page 66. This achievement is further supported by specific numbers on page 80, which reveal that the company generated $65,598 in positive operating cash flow for the year 2025. This is a notable increase from the previous year's figure of $45,872. The consistent growth in operating cash flow indicates a strong financial foundation and a promising future for the company. The generation of positive operating cash flow is a significant accomplishment for any business, as it demonstrates the ability to manage expenses effectively and generate sufficient revenue to cover operational costs. This achievement suggests that the company's management team has successfully implemented strategies to improve profitability and drive growth. The company's debt level has undergone significant changes in recent years. According to the extracted summaries, long-term debt decreased from $153,596 to $131,602, indicating a reduction of approximately 14%. Furthermore, total debt also saw a decrease from $162,445,000 to $153,409,000. In terms of interest expenses, there has been a notable decline. Interest expense decreased from $14.35 million in 2024 to $11.24 million in 2025, representing a reduction of approximately 21.7%. This decrease is attributed to the lower interest rates on the 2021 term loan facility, which saw its interest expense drop from $14.6 million to $10.4 million. Overall, these changes suggest that the company has made efforts to reduce its debt level and associated interest expenses, resulting in a more stable financial position. The management is optimistic about the company's outlook, citing its well-positioned ability to benefit from secular trends in the insurance industry. The company expects to continue growing its revenue through digital customer acquisition spending. To achieve this growth, the management is investing in AI-based platforms for traffic acquisition and prioritizing retention and growth of demand partners and supply partners on the platform. The company's strategy also involves managing seasonality by adjusting customer acquisition budgets and supply of consumer referrals. This approach aims to mitigate the impact of seasonal fluctuations on cash flows. Additionally, the management expects to have sufficient liquidity to meet operating and debt service requirements for at least 12 months. However, the company is not without risks. Regulatory changes, such as those related to consent rules and consumer privacy, may significantly impact the market for leads and require modifications to telemarketing practices and policies. Cybersecurity threats and tax risks also pose a challenge to the company's outlook. Despite these risks, the management remains focused on driving growth through strategic investments and risk management. In recent years, our company has made significant investments in its own stock through share buybacks. As of page 50, we have purchased a total of 1,218,250 shares. This trend continued into the following year, with notable purchases on September 3, 2025, and during the quarter ended December 31, 2025. These repurchases were substantial, with 3,234,894 shares bought back for $32.9 million in one instance, and 1,117,364 shares retired for $14.4 million in another. These actions demonstrate our commitment to returning value to shareholders through share buybacks rather than dividend payments. In fact, we have explicitly stated that we do not intend to pay dividends in the foreseeable future, page 42. Furthermore, a review of our past practices confirms that we have not paid any dividends, page 49. Our focus remains on investing in our business and creating long-term value for shareholders through strategic share buybacks. That concludes the financial summary for Mediaalpha Inc. Feel free to comment below, and I will be happy to answer them when possible.